Good evening, all the participants. Myself, Sujata and Chaitanya, we welcome all of you for this one-day seminar. Like it is a 2 hour session, 1 hour session, sorry, on capital gain. The reason why I say is that it's going to be more can be covered like a seminar is that the capital gain topic is very, very wide. There are a lot of questions, there are a lot of interpretational issues. So we can always plan to cover this topic in a 3 or 4 hours of session in the future. So first and foremost, I thank all of you for coming forward and joining this session. And today's 1 hour session, we would be covering all about capital gains. The reason why we have chosen this topic in today's session is that in the last year, if you look at it, there was a budget amendment. In that budget amendment, there were 2 amendments. Finance Act 2024 got amended twice. So because of that, there were a lot of changes in the capital gain. When I say capital gain, it is just not only with respect to the rate, right from the value, like the sale value we call it, or the consideration that you receive, how much to consider as far as the capital gain computation is concerned, right from there, and the cost of acquisition, the period of holding, the rate, and whatnot. There were in each capital asset there was a change with respect to pre 23rd July and post 23rd July. So we thought this is a good time to give a elaborate session exclusively on capital gain. Along with me, Chaitanya is going to take this session forward. Over to you, Chaitanya. The one humble request to all the participants is that whoever has got any doubts, please reserve it. You can either post it in the Q&A box or you can raise your hands. All your questions will be answered towards the end of the session, maybe around 3:30 to 3:45. 15 to 20 minutes we will reserve exclusively for participants Q&A. With this note, thank you so much once again. I welcome Chaitanya to take the session forward. Over to you, Chaitanya.
Thank you, Sujata ma'am, for introducing myself, and thank you, first of all, who and all participate joined in the session. So welcome to the session, and today we are going to discuss about the capital gain taxation, how it will be impact on your income part. So what are the updates covered? So post 23 July also they introduced so many updates on the capital gain taxation for resident, non-resident, those and all. Today in this session we are going to discuss. So firstly, I will present my screen and I will explain the point wise. If you have any doubts, you can raise the queries at the end of the session. So we will give the 15 minutes of time. So we will reply to your all queries and we will attend your queries. Let me share my screen. So is it visible, the screens? So the in capital gain, so before introducing of 1961, so income tax, so they are calculating in the different manner. So after income tax they taken over and they introduce the concept. So whatever income is coming to taxpayer, they brought whatever the income we are getting as a taxpayer, they broadly classified in the 5 types of income. One is a income from salaries, and income from house property, and income from capital gain, income from business or profession, which and all not covered under the all 4 categories. Second. So which and all not covered under the 4 categories. So total 5 types of income they broadly classified. One is income from house property, income from salary, income from business or profession, and income from capital gain and other sources. So today we are going to discuss about the income from capital gain sources, how it is calculated, and what are the applicable rates and what are the applicable taxes, and how to calculate those and all we are going to discuss in this session. So first of all, what is a capital gain tax? So first of all, what is a capital gain? On what basis income tax will levy the taxes on the capital gain? So okay, there is some technical issue. So what is a capital gain? So as per section 45 of the Income Tax Act, they clearly define. So what is a capital gain and what are the assets on what assets the income tax will levy the tax? So capital gain they defined under the section 45 of the Income Tax Act 1965. So capital gain tax, it's a profit or gains arising on transfer of a capital asset. If you are transferring any capital asset, if you received any gain on the capital asset, then you need to pay the capital gain tax on the capital asset. For example, if you are selling the capital asset loss, then also you need to declare in the income tax return to carry forward the loss and set up in the future capital gain. So income tax is not only concentrating on the profit of the capital gain. If you arise any loss on the transfer of a capital asset, you need to declare in the ITR and claim the capital loss, and it will be brought forward 8 subsequent assessment year. So whenever you have a capital gain in the future assets, then that loss will be adjusted against the future gains. So first of all, you should have a capital asset. That capital asset should be transferred due previous year. Then only the capital gain will arise. So what is the capital asset? So everyone, they have a doubt, what is the capital asset? So capital asset, they define clearly income tax. So it is a property of any kind. It may be a mobile or immovable property. It's an intangible property, whatever it is. So held by the SSC, whether it is in the name of business or profession, those it will be called as a capital asset. And some of the items they clearly exclude from the capital asset, even though it is a mobile properties. Example, stock in trade. Stock in trade is like a business. For example, you are doing a business, then if any assets you have, the stock in trade will be the gain any arrive on the stock in trade will be taxable in the head of income from business or profession. It is not taxable under the capital asset. So and the personal effect also they have personal effect, which is a movable and for property personal asset. So all personal asset will be not a capital asset. They specifically exclude the 4 items: stock in trade, personal effects, and rural agricultural land, and some of the bonds which is notified by the government of India. So stock in trade, I told, so it is not taxable under the head of the capital asset. Personal effect also it is not taxable, but they given some exception, even though if it is a personal effect. So if you are selling jewelry, archaeological collection, drawings, paintings, sculptures, or art of any work, if you are selling to someone and if you receive any gain on these assets, you need to offer to the income tax department and pay the respective taxes on this. See, everyone, they have a doubt. Jewelry is a personal effect. Why we should pay taxes on the jewelry? So recently, the jewelry, if you see the value of jewelry, it went to 10,000 also. When you bought that time jewelry maybe a 200 or 300. Now the value of the jewelry per gram it went to 10,000 also. The government is so day by day they are coming with the updates. If you are selling jewelry also, so you need to offer to the income tax department. So entire jewelry is not attracting the capital gain tax. So whatever sale value minus purchase value on the gain amount only you need to pay the capital gain tax. In the same way, archaeological collections, if you have any archaeological collections, so if you have an habit to collect those and all, when you are selling to someone, so it is not a income under the business or profession, it is a income under the capital gain income. So that one you need to offer to the income tax department as a capital gain. In the same way, drawings, paintings also. So if you have an art to draw any picture and all, that drawings you are going to sell to someone, if you get any gain on the drawings, you need to offer that same to the department. In the same way, rural agricultural land. So everyone they have a doubt. If I selling the rural agricultural land, is it taxable? Yes, rural agricultural land specifically they excluded under the definition of a capital asset, provided they have given some restriction, some condition they have put on the rural agricultural land. If you satisfy the all condition, then only it will come under the rural agricultural land. Otherwise, it will be treated as a agricultural land. It is we need to offer to the taxation. Example, rural agricultural land, I will define in next session. So certain government bonds, I told a few of the government bonds introduced by the government of India. So example, gold bonds, national defense bonds, those and all, if SSC you are having, if you are selling the gold bonds and the national defense of the gold bonds, if any gain arise on such bonds, no need to, you can offer for the income tax department, but there is no capital gain tax because it is a not at all. First of all, there is no capital asset. And there is one more important point we need to tell. As a foreign institutional investor, any securities, it's not only, so even though if he is having a land, so for him, they given a point on the foreign institutional investor. If any asset, the foreign institutional investor having the asset, so at the time of selling, that foreign institutional investor, he need to offer to the income tax department as a capital asset, and the taxes has to be paid. In the same way, so unit linked insurance policy also, if previously these and all, so day by day income tax is coming with the big updates, so that they are covering most of the wherever the taxpayer has choosing the savings purpose, and wherever they are crossing the conditions. So for example, if you have a LIC premium and you are making the payment, there is a condition on the life insurance premium also. If you are paying the life insurance premium, 10% of the sum assured above, then at the time of maturity, that LIC also will get taxable. So that's the reason they have put the condition. So no need to pay the 10% up. So voluntarily we can make the payment LIC also more than 10%. In the same way, unit linked insurance policy also, if it is issued after 1st February 2021, and which is the sum premium is payable exceeding 2,50,000 per annum, at the time of maturity, the amount will be taxable and it is treated as a capital asset. So I told the rural agricultural land is a not taxable, and it is a, first of all, it is a not capital asset. No. So I will tell you rural agricultural land. So what is a rural agricultural land? What is a rural agricultural land? If the population consisting less than 10,000 in the area, then within that surrounding limit, whatever the land is rotating, whatever land is in that surrounding area, land is selling, that it will be a rural agricultural land. Yeah. For example, if the population is consisting more than 10,000, but it's a less than 1 lakh, So same way, if the population is consisting more than 10,000 but less than 1 lakh, so then the whatever land is you are selling, it should be more than 2 kilometers outside the municipality or cantonment board. So if the population is consisting more than 1 lakh but less than 10 lakh, then the limit will get increased to 6 kilometers from the municipality or cantonment. In the same way, whenever we are selling the land that the area population is consisting more than 10 lakhs, and then we need to see 8 kilometers away from the municipality or cantonment board. If it is beyond that limit, then you are selling that type of land, then only it will come as a rural agricultural land. Otherwise, it will be capital asset and we need to offer for taxation. So, and I told capital gain taxation, so you should have a capital asset and there should be a transfer done during this year, means previous year. And some of the transfer, even though if you have a capital asset and transfer during the year, it will be not considered as a capital asset. For example, if you have a land and you are transferring to someone as a gift or a will or inheritance, then the whatever transfer you did, it is not a capital asset because you are giving the land as a gift. In the same way, partition of HUF also, whenever there is a partition of HUF will transfer some of the asset on the name of Karta and the respective persons. So the transfer, it will not get treated as a transfer and it no need to offer for the taxation. In the same way, one second.
Presentation. Share screen. Screen. Share. Okay.
And so even though if you have a capital asset and the transfer done during the previous year, then such transfer should not be treated as a capital asset. Example, like a partition of HUS, these are covered by the income tax department. If you are transferring a land or building or residential house to someone as a gift or will or inheritance, then such transfer will not be treated as a transfer. No need to offer for the taxation. In the same way, holding company and subsidiary company also, if any asset is transferred by holding company to the subsidiary company and the subsidiary company should be in India, then such transfer, whatever asset transferred by the holding company to subsidiary company, it is not treated as a transfer, that the capital gain tax will not attract. In the same way, subsidiary company transferring asset to the holding company is set up in India, then such transfer also it is not taxable because it's a not at all transfer. It should be both Indian companies. In case holding is transferred to subsidiary is transferred to holding, either one of the entities should be in India, then only this tax will not come. In the same way, amalgamation, demerger also, whenever they are going to amalgamation, that amalgamating company will give the new shares to amalgamated company. That shares whatever given by the amalgamated company to amalgamating, such transfer will not be treated as a transfer. In the same way, demerger also, when the demerged company, whenever demerging to the resulting company, demerged company will give the shares to resulting company. Such transfer will not be treated as a transfer because it is specifically covered under the definition of Section 47 of this Income Tax Act. So, and there are the capital asset. There are two types of capital gain they covered. So one is a short-term capital gain, one is a long-term capital gain. What is a short-term capital gain and what is a long-term capital gain? So income tax, purely they will levy the tax on the basis of this. If it is short-term capital gain and there will be some different types of taxes. If it is a long-term capital asset, there will be different types of taxes rate. So I will tell you what and all will cover the short-term capital gain and what is the period of holding. If you are holding within these months, then it is a short term. If you are not holding beyond that, it's a long term. So example, if you are having a listed securities like equity shares, preference shares, if it is listed in the recognized stock exchange like Bombay Stock Exchange, Mumbai Stock Exchange, those and all it will cover under the listed securities. If you are holding these type of securities at least 12 months, if you are holding the securities more than 12 months, it is a long-term capital asset. If you are holding 12 months or less than, then it is treated as a short-term capital asset. In the same way, unlisted shares also, it is not listed in the listed stock exchange like Bombay Stock Exchange, Mumbai National Stock Exchange, then we need to check the holding period. If it is unlisted shares, then we need to check whether it's a short-term capital asset or long-term capital asset. If you are holding less than or equal to 24 months, it is a short-term. If you are holding more than 24 months, it is a long-term capital asset. Other than shares, if you are holding land and building, these and all it will cover under the 24 months. If you are holding any other capital asset, then we need to check whether it is less than or equal to 36 months. If it is short-term capital asset, if it is more than 36 months, it is a long-term capital asset. So I'm telling what is a transfer, what transfer also they clearly defined in the Income Tax Act. What and all will cover under transfer. If you are transferring any land to someone, then it is a covered under the transfer definition. If you should transfer a capital asset, it should be covered under transfer definition. If you are transferring the land like sale, it is a covered under the transfer definition, and we need to offer the taxation. In the same way, exchange also, it is some of the people they will think we can interchange the land from one person to another person. Will it be covered under the taxation, and do we need to offer for capital gain tax? Yes, because exchange also is a type of a transfer, and it is covered specifically in the definition of the transfer. So whenever you are doing the sale transaction or exchange transaction and relinquishment of any right on the capital asset or extinguishment of any right on the capital asset, or in case sometimes government will acquire the compulsory land acquisition, so then also it is treated as a transfer, even the government is acquired by the compulsorily. So, and the conversion of an asset into stock in trade. So whenever you have the land and you are going to convert into a stock in trade, so such income is treated as a capital asset, but it will be not taxable on the year of transfer. It is taxable on the year of receipt. For example, if you have a land and this land you are going to sell in the piece and parcel as a sites. So, and you are doing business. So first of all, you are converting the capital asset into the stock in trade. The conversion of capital asset into stock in trade, it is a capital asset. So you need to pay the taxes on such conversion. But the capital gain tax you need to pay only at the time of selling. Like you are converting the capital asset into the stock in trade. Later, that stock in trade, you are going to sell into the normal business user. Whatever receipts will come, that time we need to pay the taxes on the conversion. Same in the joint development agreement also, that landowner will give the land to the joint development authority. That transfer also, it is covered under this section. Slum sale. Slum sale, it is like a business. Whenever you are doing a business, entire business you are selling to outsiders. That outsiders, they are going to acquire the entire your business. On that, he will not sell the individual asset wise. He will sell the entire assets to the seller. So this type of transaction is called as a slum sale. This type of transaction is called as a slum sale. This sale also covered under the capital asset, and it is always short-term capital asset only. There is no long-term and short-term capital asset. Same way, as I told, unit-linked insurance policy. If you have a unit-linked insurance policy and you are paying a premium 250,000 per annum, then this unit-linked insurance policy will be treated as a capital asset, at the time of redemption, you need to pay taxes on the ULIP. So what is a period of holding? Everyone and most of the people, they have a doubt. So as I told here, so it is not considered, few of the transaction it is not considered as a transfer. Then how period of holding will be count? Example, if you are going to transfer a land as a gift to someone, that new person will acquire your land and later he will send to the third party. So what is the period of holding? Because period of holding only primary criteria will decide whether such transfer is a short-term capital asset or long-term capital asset. So the second party, whatever you are giving the gift, your land to the outsider, later he will transfer to the third party. The second party, he will get the benefit of period of holding when first party acquired. Example, first party acquired in the 2005, he given the land gift to in the 2008 to Mr. A, acquired the land in 2008. Mr. A acquired the land in 2008 and he transferred as a gift in 2012. So Mr. B sold in the 2025. So when he will, what is the period of holding Mr. B? If you see in Mr. B, actually he is holding 2012. But he will get the benefit from the 2008 onwards. So whatever Mr. A purchased in the land 2004, 2008, later he transferred in the 2012 as a gift. 2012 to 2025, he transferred to so he will get the benefit from 2004 onwards. In the same way, partition of HUF also, whenever the HUF is partitioned, the whatever assets are in the name of HUF, he will transfer to the Karta. That Karta, he will get the benefit when HUF will actually holding the asset. In the same way, holding company, subsidiary company also, whenever they are transferring the asset, it will count from the starting of the asset acquired, not on the second transfer. So period of holding, actually, as I told, it is between the date of sale and date of purchase. Date of purchase is actually we need to take as a date of first purchaser. So we, as I told, so once you decide the capital asset and you have transferred and you know whether the period of holding less than 24 months or 12 months or 36 months, based on that only income tax will levy the taxation. So what are the taxes? I'm going to do what are the taxes and what are the applicable taxes for the capital gains in this here. So if you have a land and building, as I told, if you have a land and building, you should hold at least 24 months. If you are holding more than 24 months, then if you are holding more than 24 months and selling after that, then the such transfer will be treated as a long-term capital asset. It will be attracted as a 20% tax. If you are holding the land and building and you are selling before 24 months, such asset should be treated as a short-term capital asset, and it is a short-term capital asset, and we need to pay the taxes on respective slabs. For example, if you are you are selling, everyone they are doing the sale of doing the sale of securities in nowadays. So that's why they given. So not only now, it's previously onwards it's there. If you are doing the sale of transaction on equity shares and mutual funds and the equity shares, the holding period will be restricted to 12 months. If you are selling 12 months or less than 12 months, it is a short-term capital asset. If you are selling the shares or equity of mutual funds more than 12 months, then it is treated as a long-term capital asset. The taxes also, it's a different for the shares. If it is a shares, then if it is a long-term capital asset, then we need to pay the taxes on 10% only. If it is a short-term capital asset, then the SSA has to pay the 15% of the tax. Other than sale of securities, it's like land and building. If it is a long-term capital asset, if it is a long-term capital asset, land and building, in the same way, 20% is the 20% is a long-term capital asset. If it is a short-term, other than sale of securities, it is a 20% is the tax. And recently in Finance Act 2020-24, they brought few amendments on the capital gain taxes also. So you can say you can divide 23 July 2024 before that, after 23 July 2024. So they increase the capital gain tax rates also, and they revise the period of holding also. So sale of securities, as I told, if you are holding less than 12 months, then it is a treat as a short-term capital asset, and you need to pay taxes on 15%. We are selling the sale of securities after 23 July 2074. Then they introduced a new rate of 12.5% of capital gain tax rate. And if you are holding the long-term capital asset as a shares, then you will get a 1,25,000 exemption. Over and above exemption only, you need to pay the taxes. If it's a entire long-term capital gain is below 1,25,000, no need to pay taxes. Just you need to offer the tax for taxation purpose, and you can claim the exemption. If you are getting more than 1,25,000 on balance amount only, you need to pay the taxes 12.5%. Same short-term capital asset also before 23 July 2024. If you are selling equity shares and you arrive at the sale of short-term capital gain, you need to pay taxes on normal slabs rate. Post acquisition also normal tax rate, because there is no change in here. In the same way, land and building, if you are selling after that, as a resident, you can claim two benefits. One is with indexation, another one is without indexation. With indexation, post 23 July 2024, if you are selling land and building and it is a long-term capital asset, as a taxpayer, you have an option to choose either 20% with indexation or 12.5% on the capital gain amount. So this is the new tax regime, and the tax rate is applicable if you are selling the equity shares, and it's a 20% tax rate. Other than short-term capital gain, it's a slab rate. In the same way, if you are selling the equity shares and the nature is long-term capital gain, it's a 12.5%. Over and above 1,25,000. So if you are selling the long-term capital asset other than the equity shares, then 20% is applicable. So how income tax will calculate the capital gains? As I told, how they know whether we have sold the capital asset, how department will know. So department has given the instruction to the bank people and register office. If you are selling the property more than 50 lakhs, automatically register office will put a condition that you need to deduct the TDS and you need to submit the challan to the register office for the registration purpose. Once you cross the threshold limit of 50 lakhs, then automatically register officer will inform to the income tax department that this person has sold the property to so and so person. This is the sale value. Some cases, if you are selling the property below 50 lakhs, then how income tax will get reported. So income tax department has given instruction to the bank people, if the selling the property, it is a more than 30 lakhs, automatically income tax department, more than 30 lakhs, automatically bank people will give the instruction to the income tax department. So how capital gain will get arrived? So the entire sale consideration, we need to calculate how to calculate the capital gains. For your understanding, we will give the one example. So whatever sale value, you need to take the sale value as per the sale deed, how much you sold, less expenditure and transfer. Expenditure and transfer, it will cover brokerage also. Some of the people, intermediate, they will pay the brokerage on the sale of transfer. That expenditure will be allowed as an expenditure, provided you should have some valid proof, the document. So you cannot claim the nominal expenditure like that. You should have some proof to claim the expenditure and transfer. So total sale value of consideration, and you need to reduce the expenditure whatever you incurred on such transfer. The net sale consideration, on that So this indexation benefit will be applicable only on long-term capital gain asset. It is not applicable on the short-term capital gain asset. So this is also benefit given by the department. If you are holding a short-term capital asset, so you will not get the indexation benefit. If it is a long-term capital asset, you will get the indexation benefit. So cost of acquisition, as I told, if it is a if it is a gift given by some other person, you can take the period of holding from the first party. This benefit also you will get it. That's why period of holding and indexation benefit also you will get it at the time of calculation of capital gain. And some of the people, they will enter the sale transaction which is lower than the stamp duty value. So income tax, they told, so whenever there is a transaction you are going to enter with the buyer, it should not below the stamp duty value. If it is a below stamp duty value, then the stamp duty value will be treated as a deemed value as a sale consideration irrespective of the sale deed. So it should be the minimum stamp duty value. You should not take below than that. And there is one exception also. For example, if you are selling the property is some 100 crores and the stamp duty is 110 crores, gap between it's a 10 crores. In that case, the government has given the relaxation. If it is a below 10% means, then you can claim the 100 crores only as a sale value. I will give one more example. If the sale value is 100 crores and the stamp duty value is 120 crores, then we should take a sale value as 120 crores because it is exceeding the stamp duty value. So we need to take the 120 crores only for the calculation of capital gain purpose.
Yeah. So I would like to add something here. Thank you so much, Chaitanya. See, the differentiation what he wants to bring out here is that irrespective of the consideration that you receive, some of the cases, the illustration what he said, 100 crore may be the consideration that you have received, but still the stamp duty value paid is on 110 crores. So what you need to consider as far as the income tax is concerned, it is only 110 crores. It's not the 100 crores. So this is one thing. And I think prior to 23rd July and post 23rd July was already. Yeah, that also he will explain in detail. Yes, over to you.
So this is the rates I told with effective from. So as I told, so you need to bifurcate 23 July 2024 post to 23 July 2024 because in Finance Act 2024 they bought some additional rates also, period of holding, they revised everything. So this is the brief explanation I'll give it to you. Example, if you are selling the sale of shares before 23 July 2024, it's a 15% of taxation. Post to July 2024, it's a straight away 20% taxation. In the same way, if you are holding a long-term capital asset and selling before 23 July 2024, then it's a 10%. In the same way, if you are selling the same long-term capital asset on the shares post July 2024, then it's a flat rate of 12.5% without indexation. Other than shares like building, jewelry, what and all I told. So pre-July 23, before 23 July 2024, it's a straight away 20% taxation, and they reduced this rate to 12.5% without indexation.
So basically, one thing which we have to keep in mind is that post 23rd July 2024, the indexation benefit has been removed. But there is an option for resident assessee. If they want to opt for 20% also, they can in case of immobile property.
But that is not allowed for non-residents.
Non-residents, it is prohibited. So as far as the non-resident is concerned, the calculation is very simple. The sale value less the cost of expenses, like expenses incurred towards that sale, less the cost of acquisition. And also if they have done any improvement towards the property that they are selling, that can also be reduced. So as far as the NRI is concerned, the calculation is pretty simple. It is sale value minus the cost incurred towards the acquisition of the property. And as far as the rate is concerned, it is only 12.5%. There is no other option of opting for a 20% and then with indexation, without indexation, that has been removed.
So, and I will tell you this, for For example, some of the properties you bought before 2001, how you will arrive the cost. This is also most of the taxpayers has a doubt how we can decide the cost if it is acquired through inheritance. If you bought in 1996, 1994, how we can derive the cost of the.
So basically inheritance and gift. So we will just add 1 minute of explanation here. There could be a property which comes through inheritance. It can be like from their grandfather or great grandfather or father. If somebody acquires any property through inheritance, or it can come through gift. Gift can come from relatives. So if that comes, the property comes to them through inheritance or gift, and the property, the original property which has come was acquired prior to 2001, say in the year 1976 or in the year 1980s, for which you don't have any fair market value, and also the whatever purchase price which is there in the original sale deed at the time of purchase could be very, very minimal. It could be very less. So considering that, they have designed a formula where it is very clearly specified by the CBDT that as on 1st of April 2001, the market value, fair market value as on 1/4/2001 can be considered as a base value. So this methodology is followed only to pass on the benefit to all the sellers of the property. So some of the cases, what happens, they do not have the fair market value, because going back in time and finding out the fair market value is very difficult for anybody. And whatever value they on their own, through their own inquiries, if they find out and then make that as a cost price also, it would be very difficult when at the time of scrutiny. So what we suggest to all our clients is that it is always advisable to get it from the CBDT's empaneled registered valuer. They are basically the chartered engineers. So once when you engage them, they will come to the property, inspect the property, and then give the market value as on 1/4/2001. So that is one way of doing it. In some of the cases, what happens, if you take the state of Karnataka, where we have a Kaveri portal, we will also get some guidance value. What is a property around that area. Say if you are taking as a JP Nagar first phase market value will be different from market value of the property which is in 6th phase or 7th phase. So wherever your property is, just take the reference very closer to that place, go to the Kaveri portal, get the market guidance value. From there you can take the reference, keep it for your whatever reference you are taking it from the common portal, you keep it for your evidence, so that in future if the department comes out for scrutiny, you will be in a position to submit it. So this is how the fair market value as on 1/4/2001 should be arrived at. So whenever you are arriving at the fair market value, it is asked for two reasons. One is that to find out the exact value. Second is that some of them would have constructed, right? So they would have purchased the land, they would have incurred. In those times, cash was very predominant. So they would have incurred cash for constructing that house. So how do you arrive at what was the value, how much of cost has gone into that immobile property? We may not be knowing. So if you engage a CBDT registered valuer, he will be in a position to come and inspect the property, and he will assess the property saying that this is how the quality of construction is, this is what the flooring, this is how the furniture is. So considering all that, he will give you the valuation report. Basis that you can take the fair market value as on 1/4/2001.
So in how indexation will be useful, so I will give the simple formula. Example, if you purchase the property in 2004, its a value is 100 rupees. So base value, the indexation, you can check in the income tax portal, what are the indexation value for 2004 and 5. And when you are selling the property in 2024 and 25, you need to check what is the indexation value for 25-26. Based on that, you will get the proportionally increased cost. This will reduce your capital gain tax. That's the benefit of the indexation. Like 100 rupees you purchased in 2004, now you are selling 400 rupees. Due to indexation benefit, that 100 rupees, it became to 250 rupees on net. 450 minus 250 on 200 only, you need to pay the capital gain taxes. If this benefit will not applicable to short-term capital asset. As I told, NRI non-resident taxation. For non-resident taxation, they have removed 20% indexation benefit post July 2024. If NRI selling the property before 23 July 2024, NRI can avail the benefit of 20% with indexation. But post July, they specifically given this benefit to resident only. A resident can choose either 20% with indexation or 12.5%. But as a NRI, you cannot choose the 20%. Straight away, you need to pay the taxes on 12.5% on capital gain. Sale value minus purchase value, the differential gain amount, I need to pay the taxes of 12.5%. And NRI can also avail the benefits of Section 54, Section 54EC, and Section 54F. Only he has to meet some conditions are given. If the conditions are met, then NRI also is eligible to avail the exemptions under Section 54, 54EC, and 54F. There are few exemption sections given by the Income Tax Department. By using these sections, taxpayer can choose the appropriate section and he can avail the benefit of exemption. So, example, if you are selling a residential house property, then then Section 54 is applicable, exemption section. So, if you are an individual HUF and selling the residential house property to outside, selling the house property to the person, then for a taxpayer, he has two options. He can pay the taxes and he can hold the money. And another option, he can buy another residential house within 1 year before date of acquisition, or 2 years from the date of transfer, or he need to construct another house within 3 years from the date of transfer. Like, for example, if he acquired the property, if he is going to sell the property today, he can residential house. He has two options. He can pay the taxes today and he can no need to invest anywhere. And another option, he can invest in the house property either 2 years from the date of sale. He need to buy a house, or he need to construct 3 years from the date of sale. He need to construct one more residential house, or else he need to buy one house property with the back date of 1 year before the sale of date. Then he can avail the exemption. This exemption also proportionately will get eligible. You cannot avail the entire amount on the net consideration. Section 54B also, it is applicable only for when you are selling the agricultural land. So rural agricultural land, as I told, rural agricultural land is not a capital asset, provided you should satisfy the population and their limits. If it is other than these limits, then it will fall under the capital asset and you need to offer for the taxation. For that also, income tax specifically given Section 54B exemption section, that agricultural land should be used by the taxpayer at least 2 years when he is selling. And he can acquire another agricultural land, and that the restriction on the further transfer of such new land will be 2 years. He cannot sell 2 years after acquisition. So, as I told, compulsory acquisition by the government from the SSC, capital gain will arrive only at the time of acquisition by the government, but the capital gain tax will need to liable to pay only at the time of receipt amount from the government. He no need to pay tax in advance. Compulsory, if any land is acquired by the government on the compulsory acquisition, then SSC has an option to choose. He can invest land or building in the industrial purpose. He can take a land in the land or building in the industrial area. Such land or the building, he should not sell to outside person. There is a cooling period of 2 years. Same way, exemption on the capital gain on the salary. So Section 54 specifically they designed for the sale of residential house property. Section 54EC, other than residential house, and it says specifically land and building. If you are selling land and building, then Section 54EC will be applicable as an exemption section. This is Section 54 is applicable only for individual and HUF. If other than Section 54 is applicable, any person, individual, HUF, company, anything. If you are selling land or building, then SSC has an option to choose. He can buy a land or he can invest in the bonds. So National Highway Authority bonds. So maximum we can invest in the bonds is a 50 lakhs, and that the period of further transfer is a 5 years. If you are transferring the bonds before this 5 years, then the capital gain tax will get attracted. So the sale process should be invested within 6 months. Meanwhile, he need to, for example, he is going to purchase a one residential house after 3 years. He should not keep the amount in the savings bank account. He need to open an account in the nationalized bank and in the name of capital gain account scheme, and he need to park the amount in there. In the same way, this is a sale of any other asset. If you are selling gold, if you are selling jewelry, if you are selling archaeological collection, then this section will be useful to the taxpayers. If you are selling a gold and you have arrived the capital gain tax, then you can pay the tax or you can choose the 54 section F. So this section will be specifically applicable for individual and HUF. And whatever exemption I told, 54F and all, these and all, it is applicable to long-term capital asset. Only two assets will be applicable to only short-term capital asset. These and all will be, if you are selling a short-term capital asset, example, sale of jewelry is a short-term capital asset, then you cannot avail the section 54F. If it is a long-term capital asset, then you can avail the section 54F. New asset, and you can invest in the resident house in India. If you are selling a jewelry and you are that sale process, you are going to invest in the residential house in India. Same way as section 54, as I told, the conditions, either he can purchase 2 years from the date of sale in new house, or he can construct 3 years from the date of sale, or he can he already buy a house within 1 year before the sale of trans, then that purchase also he can claim an exemption. In case if he is going to purchase within 2 years or 3 years after construction, that amount he should not keep in the savings bank account. He should park in the capital gain deposit scheme account, which is available in the national bank account, specifically designed for capital gain scheme. So in the summary, I can say, what is a capital asset? I told, so capital asset will be anything. So it may be a tangible, intangible. So, and a few items they explored: stock in trade, personal effects, rural agriculture land, and the government of India, they noticed in the bonds. And thank you. If you have any doubts, you can raise the questions. Yes, Vishwanath. Hello. Sir, you can ask the question.
Yeah, that is. Stop sharing. You can unmute. Can unmute.
Given access.
Sir, we have unmuted you. You can raise your question. You can speak now, sir. Okay, now we'll move on to the question and answer. Let me see what are the questions come up for answering. Okay, so the question is it necessary to apply for lower deduction certificate for NRIs? Can you answer? Yeah, maybe you can give a brief on what is lower tax deduction certificate under section 197.
So lower deduction tax certificate is given by the department. Seller has to apply, whether in case if the refund excess tax is deducted by the buyer, then he can go for lower deduction. He can request the assessing officer that this is his gain. So based on that gain, assessing officer will give the certificate. Based on that certificate, buyer will deduct the tax rate. He will not deduct the flat rate 12.5%. He will deduct the based on certificate only. He will deduct.
Yeah. So basically, the lower tax deduction is nothing but it is an application made by the seller to deduct tax at a rate which is lesser than the prescribed rate. Say, for example, now we know that the capital gain tax rate for NRI is 12.5%. So why should he request in the first place, right? I'll tell you the reason. The NRI has decided to reinvest the capital gain in a property, right? So if so, there will not be any capital gain tax at all for him. Whereas this 12.5% is deducted on the gross value. So if 1 crore is the sale value of the property, 12.5% comes to 12,50,000 rupees plus surcharge plus the education cess. So if that being the case, around 13 to 14 lakhs will go off only in TDS, whereas his actual effective tax liability is zero. So to avoid, to get the benefit, it is not the avoidance, it is just to get the benefit of the rate. What he has to do is he has to apply to the international taxation wing, because this comes as an NRI. So NRI has to apply to the income tax department stating that my actual liability is nil, whereas as per section 197, I am liable for reduction under at 12.5%, effectively 15%. So kindly permit the buyer to deduct at a lower rate. So this is what the application that has to be submitted to the, it's an online application submitted to the officer. So the commissioner, after considering the what is the applicability of tax rate for the seller, and if he has any other outstanding dues, whether he has offered the property for for any kind of income if that property had generated, he has disclosed all that in India. Considering all the facts, he will assess the estimated tax liability proposed by the seller is correct or not. He will verify the workings, and then he will verify that everything is in order. Then he will permit the buyer to deduct at a lower rate. Maybe it may come to about 4, it can be 5%, it can be 2%, it can be even 1%, whatever it is. So only upon deduction, getting the deduction certificate, the buyer has to deduct the tax as prescribed, as mentioned in the certificate, and then he can remit the balance amount to the seller. So the seller, same way, only after all the formalities are completed, only after paying the entire tax in India, the balance he can repatriate to his country of residence. So this is what the basics of lower deduction and certificate is all about. Right. ESOP shares, how the FMB or grandfathering section 112 benefit. Okay. So ESOP is calculated on market value. You want to, yeah. Chaitanya.
So ESOP, Vishwanathan.
So as per I've given you the clear workings, we will share the computations with you, because we have to arrive at the market rate. What was the market rate prior to that cutoff date, and whichever is lower. This is a bit complex working. So you have got two components in your question. One is that ESOP. When it comes to ESOP, the fair market value, assuming there are, I think ESOP also, it requires a little bit of explanation. ESOP is nothing but the employee gets from his employer on account of his performance and other things. So as and when he gets the ESOP, there is no tax liability. There are two things. One is the ESOPs are granted. It's already answered. One is that the ESOPs are granted, other one is the employee vests the shares and then he sells it. There are three components to it. So at the time of grant, there is no tax liability, only when at the time of vesting, right? At the time of vesting, the fair market value on the date of vesting, less if he had paid any money to acquire those shares. Probably, see, assume an employee is working in a software company, the market value as on date of vesting is say 1,000 rupees, whereas the employee is asked to pay 10 rupees. So what he has to, the fair market value as far as income tax is concerned, 1,000 minus 100 rupees. Like, 900 rupees would be the fair market value, would be charged in the, in the form 16 as a perquisite. So on 900, whatever shares are given, allotted to him as ESOP will be charged on the fair market value on the date of vesting. In the form 16, it is taxed as a perquisite. Depending on the slab, that amount will get taxed. So it means that at the time of vesting, the employee's ESOP is taxed on the fair market value. So when he sells the share, say down the line after 4 years or 5 years, whatever is the sale price he is selling, less the base value. Whatever base value would be nothing but the fair market value that was disclosed in the form 16, that was allotted as a perquisite. So the differential would be taxed as a capital gain in this sense. So it is very important for all employees, whoever is getting the ESOPs, to keep track of how many shares were allotted, what is the vesting period. So pending how many shares are yet to be vested. It is always better to have a complete track of shares year-wise, so that it becomes easier for them when they sell the shares. So this is what is all about ESOP taxation. I hope I have clarified. So with this, we have come to the end of the session. So if you have any queries, you are free to raise anytime. You can write to us. Our email ID is given in the presentation, office.coralmetrics@gmail.com. So you can write to us, and also you can even send a message, or you can meet us for any more clarifications. So with this, we have come to the end of the session. Thank you so much for your patient listening. Thank you so much.
Okay. Thank you.